Hi everyone, it's Peter Schiff. It's Friday, November 4th, 2009. Well, we got some good news today, according to Wall Street. The jobs numbers came out, and rather than losing the expected, I think, 125,000 jobs for the month, we only lost 11,000 jobs. And in the world of diminished expectations, this is good to 10%. Again, whoopee. Also, of course, one of the reasons, if you look behind the smoke and mirrors, one of the reasons that the unemployment rate dropped, people decided that they couldn't find jobs, and so they stopped looking. And so that means there are fewer people unemployed. But of course, if you count the real rate of unemployment, which are the people who have given up looking for jobs, and those who have accepted part-time work, the unemployment rate is still above 17%, which is close to a historic high. Also, if you look beneath the numbers, we lost better than 40,000 manufacturing jobs. The jobs that we gained were in government, were in retail, were in healthcare. Unfortunately, these jobs are going to cost the economy money. We need more people producing stuff. These jobs are going to create more consumers as people have paychecks. But what are they going to buy? They're going to have to buy more stuff from abroad because we have fewer people making things and more people trying to buy things. So this means the underlying economic imbalances are going to widen. The trade deficit gets worse as a result of the fact that we're destroying goods-producing jobs and replacing them with service sector jobs. This shows that the underlying economic imbalances are still worsening. They're not getting better. So the job picture is really not turning around. And of course, a lot of these service sector type jobs that are being created are strictly a function of the stimulus. And this is all a short-term effect because to produce these jobs, we're having to destroy productive jobs and we're having to accumulate trillions of dollars worth of debt. I mean, think about it. We're not even gaining jobs. We're not getting a jobs number where we're adding 400 or 500,000 or 600,000 jobs. This is supposed to be the beginning of the recovery. This is when the job gains are supposed to be the strongest. And all we can muster for all the bailouts, all the stimulus, the trillions of dollars of deficits, all this money, all we can get is that we only lost 11,000 jobs. This is really nothing to celebrate. Of course, the overreaction in the markets is rather pronounced in the precious metals market. Gold dropped better than $50 an ounce today. I think intraday it was down maybe $60 or more at one point. The dollar had a big rise, the biggest gain in the dollar in quite some time. The dollar index was up about 120. It's now back above the 75 level. And it's interesting when I'm listening to the comments on television, this is the end of the gold run, this is it, watch out, look for the exits. That's exactly what you have in a bull market. Remember, in bull markets, the biggest moves are to the downside. They're very scary, they shake people out. This market, during this entire run in the gold market up to 1,200, all the biggest moves have been down. Remember, I think on the Friday after Thanksgiving, in the morning, gold opened down about $30, $35, and then within a couple of days, made a new record high. I don't know if this is going to be a one-day event or if it's going to take a little bit longer than that, a few more days, a week or two, but ultimately I think gold is going to make a new high again. This is just providing the worry of the wall that this bull market has been climbing. And of course, the justification or the thinking is, well, if the economy is improving based on these jobs numbers, then maybe the Fed will be quicker to remove all the liquidity. Maybe we're going to get some rate hikes, and maybe that will be bad for gold and good for the dollar. Well, there's a lot of maybes there. First of all, the economy really isn't improving. It's actually getting worse. The imbalances are going to worsen as a result of all the new manufacturing jobs that we've lost and the service sector jobs that we've added. But even to the extent that you could argue that the economy was improving based on the stimulus, the Fed can't withdraw the stimulus because they lose the improvement. All of these phony gains, all these phony jobs and the phony prosperity is a function of 0% interest rates, free money, artificially high real estate prices and asset prices. The minute the Fed removes the punch bowl, the party's over. So they can't remove it. And even if they do nudge interest rates higher, they're not going to raise them high enough to make a difference. You remember the baby steps that they had a few years ago, then when they were raising rates a quarter point at a time, the dollar was losing value the entire time they were raising interest rates because they weren't raising them fast enough to get ahead of the curve. And so what you really have to assume based on this gold decline, if you think it's real, is that the Fed is going to get aggressive with raising interest rates this time. They're not going to move up in baby steps, but they're going to be aggressive. And that despite aggressive rate hikes, it's not going to derail this recovery, when the recovery is entirely based on spending cheap money and artificially low interest rates. So once the gold traders figure this out, of course, gold's headed back up. And of course, a lot of this movement in gold is simply, the market. Gold had, I think, 9 or 10 days of record closes. Obviously, nothing goes in a straight line. All markets move. You have speculators in there. They have stops in there. And so markets are prone to volatility. I think that's what we've had. And I think the main reason gold fell $50 today is because it had risen so much in the week prior. Even with this big drop in gold, we're still well above 1,100. So people have to put this move in perspective. Also, I thought I'd mention, it was interesting, my brother, Andrew Schiff, who works at Europe Pacific, has been talking to the reporters at the Wall Street Journal who wrote the article about me in January that pointed out how poorly my accounts performed in 2008. Of course, these reporters had ignored the good performance that my clients enjoyed for all the years prior to that, but they decided to write an article about me when we had our worst year ever. Anyway, we're trying to approach them to maybe do another article on 2009 because the performance is so diametrically opposite. This is the best year ever, considering the strength in foreign stocks, the weakness of the dollar, the strength in gold stocks. I mean, gold stocks have surged this year. One of the reasons that we did so poorly last year was because gold stocks basically got cut in half. And the reaction from the reporter was that they're not interested in doing the story. They think I just got lucky in 2009. This is pretty interesting. So when the market goes down, it's because I don't know what I'm doing. But when my accounts do well, it's because I got lucky. Well, I guess I also got lucky in all the years prior to 2008. There was another publication that did a story on me in January of 2009, and that was Fortune magazine. And they're more receptive to doing a revised story. Now, the Fortune story wasn't nearly as hard on me as the Wall Street Journal. But one interesting thing about the Fortune story is they actually asked me, and this was in January, to pick 5 stocks that I thought should be bought right then for investors to profit. And so I gave them 5 stocks. Those 5 stocks collectively are up, I think, 360% since the publication of that article. And so my brother actually pointed that out to the Wall Street Journal, saying, look, these are just the 5 stocks we gave Fortune. You could just take a look at them and see how they've done. I mean, we're not showing them the actual performance of our clients' accounts because, again, we can't really do that because they're all different. But it gives them an indication of the type of gains that were possible in 2009 based on what happened. And again, the Wall Street Journal reporters didn't care about it. Again, they attributed those gains to luck. Well, maybe I was lucky in 2009, but then I was simply unlucky in 2008. But the Wall Street Journal didn't want to say it was unlucky. They were trying to use 2008's performance to try to discredit me when they didn't want to use 2009's performance to vindicate me at all, and they certainly don't want to look into performance of my clients' accounts for the 8 or 9 or 10 years prior to 2008. Anyway, I just thought that was funny. Hopefully, Fortune does do their follow-up story because I think it'll be a pretty good one, particularly if they highlight how those 5 stocks did in a year. Anyway, that's it. Have a great weekend, everybody. I will be back again next week.